Hi, I'm Bob DeLamartre, the instructor for INS 21. Today's key concept video concerns ideally insurable loss exposures. An insurance transaction or policy is not likely to be to the insurance company's advantage unless the loss exposure has certain characteristics that make it ideally insurable. Insurance companies generally prefer to provide insurance for loss exposures that have the following 6 characteristics. Number 1, loss exposures are pure, not speculative risks. That is to say that unlike gambling, the risk exists outside of the fact it will be insured. Number 2, loss exposures are subject to accidental loss. If the insured has control of making a loss happen, it is obviously not to the insurer's benefit to insure it. Number 3, loss exposures that are subject to losses that are definite in time and that are measurable. An anti-example of this would be a slowly leaking pipe behind a bathroom wall. Number 4, loss exposures are part of a large number of similar but independent exposures. This, of course, makes losses predictable. Number 5, loss exposures are not subject to a loss that would simultaneously affect other similar loss exposures. That is to say, loss exposures that would not be catastrophic. You certainly would not want to write a large book of homeowners insurance where all of the risks are located on the coast of Florida, for instance, and are subject to the same hurricane. 6, our final characteristic. Loss exposures are economically feasible to insure. You couldn't insure an individual for a loss to change in their pocket, to pocket change, since it would cost more to adjust the claim than it is worth. By accepting only ideally insurable loss exposures, insurance companies avoid speculative risks and maintain predictability and control of their book of business. Thanks very much. I'm Bob DeLamartre.